Let's see. So the first question comes in from Raj. Raj asks, how do I manage a long leap call gone wrong using power options? I have 10 contracts of a leap call, 2023, 15 strike on a position. You paid $5 for it, but it's now at 50 cents. The stock has gone down to $4. In many instances, what we've talked about before here, Raj, whether it's a leap call or whether it's just a call that you've bought that's 2 or 3 months out in time, we do have some other discussions that we went through. I'm going to navigate quickly over to YouTube, and we're going to search on the Power Options channel for manage. I think that's what I need here. So ideas for managing a losing bought call, 8 ways. Oh, that's a profitable one. Managing your long option positions. There's another one here that you might want to look for, that you can look for later, Raj, as well. And that's, can the stock repair? I don't know the exact title I put it under. Yeah, can I use a stock repair for a bought call that is down? And the stock repair tool helps you build a ratio call spread on a stock position to help you get back to break even faster. Doesn't work exactly the same on a leveraged long call position in that case, simply because we're not using a direct stock position. Now, Raj, I don't know your exact symbol. Stock at $4. So let's just do something real quick. I'm going to go to the covered call screen here. I'm going to go to search. And very quickly, Raj, what I'm going to look for, let's clear out the filters. I'm going to look at January 2023 expiration. And I'm just going to look for one strike out of the money. I don't need to isolate the 15 strike in this case. And let's see here. Oh, and I want to see stocks that are between $3 to $5 per share. Okay, so we've got a ton of them here. And wow, 137. Actually, okay, so AMRS is what Raj just sent in. Okay, so let me just see if AMRS even came up on the screen, if I've got it right. Search by symbol, AMRS. Yep, there it is. Okay. All right, so let's take a look at what we might consider. I'm just going to pull this up. January 2023. There it is, the 15 strike call, 35 by 50. Well, you bought 10. Okay, I'll put in 10. That's fine. $5. All right, so we know where we are now. We're essentially really near a 95% loss on this position with a decline. The first thing that isn't related to this, but I always want to bring this up. Yeah, this was the one, this one here kind of got away from you suddenly. It was leaning down before then. Oh, that's a terrible color. I don't like that color. All right, let's get a new color here. Let's do something brightish. Go with that green, see if that shows up any better. Much better. So you might have purchased sometime around this time, that 15 strike leap call here when the stock was trading here before this drop. Not sure if this was related to earnings or whatever. And then, even then, where were we at 7? We're at about a 50% down, and then it just continued to move down in price. And that being said, I'm not expecting this to suddenly rise back up to 15, but again, we are seeing the MACD growing since that big decline and then sort of a bottoming out here at first, but it has been trickling downward, trying to flirt with that 20-day moving average. Just can't get above it and stay above it as well. What do we have coming up? Do we have anything coming up soon? In this case, let's see here. Let me take a look. So I want to see my stock research. Still a month away, but the next earnings are coming up in March 3rd of 2020. Why is that important? If you're down so much now, why am I concerned with what's going to happen in a month from now? I know it's not the best advice, but a lot of times when Ernie and I get a question that comes in from an investor, whether it's during a coaching session, whether it's during a webinar, Raj, or anything along those lines, if I know I have something coming up in the near term, and I'm already pretty much at 90, 95% on the loss in the position, what more can I lose? 40, 50 cents right now basically is the midpoint. The midpoint's around 42, 43 cents right now. So that's all I have left to lose. I'm close to, that 90%, 95% loss in the position. There might be no harm in continuing to hold this position as is. I'd like to see the earnings in 10 days from now or 15 days from now rather than 30 days from now. But all of you have now is time value because it's so far gone. Okay. That being said, that's not technically the best answer, but it is something to consider to see what other management opportunities might be better further down the road. Why I'm leading up to it that way is because it's very difficult to repair, adjust, manage any position, whether it's a credit spread, whether it's a debit spread, whether it's a long call or a long put, when you're sitting at near 85, 90, 95% loss on the position. What are some of the common approaches that an investor might use in these scenarios? Well, with it being so far down, just like you might do on a long stock position, you might consider averaging down the trade, lack of a better term. And instead of averaging down, what you're going to do is roll it down to a lower strike. Is this going to increase your cost basis into the position? Yes. But is it also going to lower the break even to potentially a more manageable price point? Yes. Will you maybe need to see more growth in the position to get you to break even with that lower price and lower break even? Yes. Let's take a look. I take the hit now. I sell to close our January 15 strike for that 42 cents, 43 cents, whatever I can get. And I don't see a 6 strike here, but that's fine. Let's just use the slightly out of the money 5 strike, which is priced at 130. We're going to keep the same number of contracts in this case. Now remember, your current break even isn't even shown on this chart. It's $20. Okay. The static break even at expiration is $20. You would probably need the stock to be somewhere up, even in the next 20, let's go 30 days. Let's go 60 days. Just as a view here. So let's go out to April 5th, April 6th. And let's say the stock moved back up to 13, for example. Yeah, I'd still be at a loss of 67 cents. It'd probably be worth about $4.33 in that case. It's still not getting back to break even if the stock moves back up to 13. If the stock only moved back up to 10, I know that's 100% gain from where it is now, a little bit more than that. You'd be at a loss of $24.30. Okay, so still a long way to go in the next 60 to 80 days to get you back to break even. But now let's put in our entry here. What's our new position potentially going to look like? Put this up at 44 cents. Leave that at 135. You have a new total cost basis into the position of $5,910. Only $910 more than the existing position. Your static break even at January 2023 expiration is $10.91. Now, what were the numbers that we looked at before? We said, okay, best expectation, greatest of things. What happens if the stock managed to go back up to 13? Oh, sorry, folks, on April 6th. What would that do to our position? Well, we were still at a loss of 670, remember. Here it'd be at a profit of 26.60. Let's take it down to just $10 in 60 days. Still at a loss of 80, but it's more manageable. What's the other advantage of going down to this position here with a cost of $5.91 per contract, now owning 10 calls at 5? Well, let's just do that. Let's put in just the static price. We get $400 back, $440 roughly, for selling to close our existing option. Maybe it's only 40 cents, but then we pay $13.50 for this one. So we go up to $5.91. We add that $910 for this position. But where are you now? Yes, you have a higher cost basis. Don't get me wrong. What could potentially and already is, roughly close to a $4,570 loss could be a full loss of $5,910. You are adding to the cost basis just as you would averaging down the stock. But now you've got a call at 5. Yes, the static break even is pretty high. Again, it's up in that $10 range, but I could start trying to knock the cost basis down shorter term. There's no premium there. So you'd have to go out maybe 30 days, but not, it's too close. I don't want to go to March 4th because you have the earnings coming up, but it was maybe trying to generate some premium against it by doing maybe a horizontal spread. You just sell 10 contracts against it. You're only going to get about $50, $120. That's not bad. But what you're doing now is trying to knock down the cost basis a little bit more before the earnings coming up. Why am I not suggesting that right now, when you're this far down, you start selling calls against it at lower strikes? Because then that creates a completely bearish position. And I don't want to suggest that you just hold and hope onto this position. And I'm not suggesting doing that. Normally, we like to close one of these long calls just as we would our spreads. If the stock hits, if the call hits a 40 to 50% loss of our initial investment, we don't want to let it go more than that. But now you're already in the situation here, and we're at 85, 90% loss. The calendar is one. Rolling down and doing the calendar is one way you might consider managing this position. Just rolling down, you had made a comment that you said big catalysts expected. Well, this helps you get down to a different break-even price in that case. Yes, it's only $10, but the break-even, is about $10, $10.91 actually. Static break-even on January 2023 expiration, Raj, excuse me. But it's not $20 where you are now. Your static break-even's at $20, holding the 15 call and paying $5 for it. Yes, you increase the cost basis. Yes, you're putting more money into a trade that's already losing. But if you're still staying in this position because you're hoping it's going to come back up and you expect some catalysts, rolling it down to a lower at the money or maybe even slightly in the money strike is going to give you a better break-even if that happens. And now that you're at the lower strike, it opens up other opportunities to maybe sell premium against it, create a diagonal or poor man's covered call. Tough to do because the premiums are so low. I see that. And you don't want to necessarily start selling the standard March expiration here going further out in time because you don't want to cap your gain if the stock really takes off from the earnings or even has a good movement from those earnings coming up way down the line in 30 days, not way down the line as well. Of course, there's all sorts of different other things we can do here that get a little bit complicated, keeping with the same expiration rather than turning this into a calendar. Now, I may be able to go out to January 2023. I doubt it's going to work. It's definitely not going to work. But we lowered the price and lowered the break even. But I can get some premium against it selling to January as a debit spread, but it doesn't give me enough. The debit's 485, and I'm in a 2-point spread. So in order for a debit spread repair to work in this situation, we'd have to open it up to that 10 strike, which unfortunately is only 70 cents. I don't even know if that works, to tell you the truth. I don't think it does. No, it doesn't give us enough. We're still going to be at a guaranteed loss, even if it comes back up to 10 on January expiration. Only a loss of 185 compared to that, $4,560 loss we're looking at right now. So this doesn't get it to a repair. What about the butterfly? In other words, if I change this to a long-term butterfly by selling 2, this would effectively be not quite the ratio repair because the ratio repairs aren't going to work here on this. I can already see that. Yeah, the ratio repairs won't work here. All right, so what am I going to do? I'm going to sell 20 of the January 7 calls and buy 10 of the January 10 calls. So we're going to enter sort of a ratio spread depending on what you're qualified to trade in your account. What you might have to do is enter this as, after you roll down to the 5 call, turn it into a bull call debit spread by selling 10 and then enter another bear call credit spread, 10 contracts of selling the 7, and buying the 10s. That way they link it together. They don't see that any short calls or think any short calls are naked in that scenario with a high margin. And this one still didn't work for us. Okay, it didn't get us to break even. In fact, the best case scenario is still a loss of 2,500. So that's not something that would work. Sometimes that's used in these scenarios, but it doesn't look like it's going to give us a potential profit on the trade. So those are some of the ideas you might want to consider. Number one, no one wants to admit this, but do nothing. Hold on to the position. You're already at near 90 to 95% loss on the trade. That $42, $43 midpoint remaining in time premium, Raj, is all you have to lose. Even if you hold it for the next 30 days, the stock continues down in price. I don't want to see that happen to you, I know, but it's something you consider to leave the position as is. And then if you get the move you're looking for from the earnings on March 3rd, you'll see better opportunities maybe to roll down at that time and adjust the cost basis. Number two, just like you might do with a stock, average down the position. You can roll down the call to the lower strike price as we showed. That gives you a potentially better break even. Would see a gain if the stock went up to 13 in the next 60 days to April. I'm not saying that that's what I think is going to happen with the stock, but you'd still be at a loss if the stock went up to 10. But then you might have an opportunity to pocket some of the profit you have on this new 5-strike call, even though it's not at a profit on the entire position, and sort of roll it up in that case. You might see a different kind of cost basis that you do. So you could roll down here and do that. And then 2A, once you roll down, of course, you could look to evaluate selling calls short-term against it, but you don't want to cross beyond that March 3rd earnings date in that case. We didn't run an example, but I could just see mathematically, in order to do the stock repair position that I showed, that we had mentioned, against this higher price call that's near 90% loss, we'd have to roll down first to see if we could get a repair. And the repairs didn't work as a credit. And I don't think the repairs would have worked as a debit. But we also saw here in this scenario that once you roll down, trying to force the butterfly against the position wouldn't seem to work either. Now, number 4, sorry, I'm just going to write it down because it was there. So doing any kind of condor or elaborate multi-leg spread trade against this leap call that's down 90, 95% or so, I didn't see anything that looked like it would be able to profit. Now, number 4, you could consider doing the roll down. We didn't show this exactly. Oh, sorry. We could consider that roll down, but instead of staying in January, you could get a lower cost basis. It'd still be above 5 points. You're pretty much pocketing that 5-point loss on the position, even when rolling down. That doesn't change. Or I should say $5 cost into the position is still there as a potential loss. But instead of rolling to January, you could move it in closer in time. So instead of paying that $13.45 or $13.55 it was for the January 5-strike call, the 135, excuse me, you might only see a cost of 80 or 90 cents by, say, rolling into a June or July 5-strike call, which would still cross the March earnings and might still cross a second earnings in June or July. It's not going to get you to break even, but what is it going to do? It's going to get you to a point where you might have a slightly lower break even than the cost of $5.91. It might only be $5.96, $5.97, something along those lines. So let's think about that real quick. What are our options here? You've got March's, the June series. The June 5-strike is only 75 cents, 85 cents. So remember, we were going to get about 42, 43 cents back, or $440. Buy this for 80, but we still have the $5 cost there. The new cost basis of the June 5 call, instead of being $5.91 for the January, would be around $5.35, $5.40. So that would help the break even a little bit, but now you have less time for the stock to move. It might be worth it if you decide to roll down to stay in the January and pay the extra 50 cents here of cost basis for an extra 6 months of time for the stock to recover and to potentially be able to sell new calls against it after you've rolled down to the 5-strike. Okay, so those are some of my general thoughts in these scenarios. Once these positions hit this near maximum loss on the position, there's not a lot of repairs that can be done to get it back. You first have to consider averaging down in that case, and then evaluating what you want to do next. Okay, but as I mentioned before here, take a look at some of those other ones when you have the time. You can look at this one honestly, but I don't think it's going to help you just based on the numbers that I saw for your AMRS. But yeah, we wanted to look at manage a long call. So other ideas that might work, but I'm not sure if they're going to work with this type of unrealized loss on the position so far. Ideas for managing a long call. Currently, long calls that are going against them, can management techniques be applied? So those two, using the stock repair and this one, might help you that scenario. Raj then asks, good analysis, we will be posting this on YouTube. Yes, of course. We're going to go through tonight. I'm going to go through tonight, excuse me, at some point and start cropping these discussions out one by one. And I'll hope to have the first 3 or 4 posted tomorrow morning, usually by 11 a.m. Eastern time, 12 noon Eastern time, definitely. And then we'll send out an email, Raj, when those are posted as well. Okay? So we'll let you know as soon as that's posted and expect to see it tomorrow morning with our other discussions that we're going to get into right now as well.